Let's be real, ICT concepts are some of the most powerful tools in trading, but most traders struggle with them. Liquidity, fair value gaps, order blocks, they often sound confusing and overwhelming. But here's the truth, smart money uses these exact concepts daily to trap retail traders and engineer moves that look random but aren't. In this video, I will break them down step by step. Why liquidity gets hunted, the secret behind fair value gaps, how institutions use the power of 3, and how to trade order blocks like a pro. Make sure to like this video and subscribe, and turn on the notification button to get notified when we upload a new video. Let's dive in. So let's start with one of the most misunderstood yet powerful smart money tools, the fair value gap. So what exactly is it? A fair value gap is a price inefficiency created when the market moves so aggressively in one direction that it leaves an unfilled space between candles. This imbalance shows where price didn't trade fairly, and it often acts like a magnet that pulls price back for a retest. Traders use these zones to identify precise entry points, and when applied correctly, they deliver sniper-level accuracy. To identify a fair value gap, look for 3 consecutive candles. The middle candle should move strongly in one direction, while the first and third are smaller. If the high of the first and the low of the third do not overlap the middle, the gap between them is the fair value gap. Highlight that zone with a rectangle. It's your area of interest. This applies both ways. Bullish gaps appear as price surges upward, bearish gaps as price drops rapidly. If there's no space between the first and third candles, it's not valid no matter how large the middle candle is.
Let me show you 4 steps to filter the best setups. Step 1. Stick to fresh, unmitigated gaps. The most powerful zones are those price hasn't revisited. Once the price returns and fills it, the gap weakens. If the price retraces too deep and closes inside, the setup is invalid. Ideally, you want a clean touch, respect, and bounce. Step 2. Check the size of the fair value gap. Larger gaps show a stronger imbalance between buyers and sellers, making them more reliable. When multiple gaps appear, prioritize the bigger ones. Step 3. Be cautious with gaps near major levels. If a gap forms right under a supply level or just above a demand zone, price may reject from those levels and zones, which may result in price invalidating the fair value gap setup. Always check the surroundings. Step 4. Focus on gaps that form right after a break of structure. When price breaks a key level and leaves a gap behind, that zone becomes a high probability entry for institutions. The first retest often sparks a strong reaction. Alright, the liquidity ICT model is one of the foundation of all smart money concepts. Liquidity is often seen as the zones on the chart where clusters of pending orders sit, mainly stop losses. These levels act like magnets for institutions because they know exactly where most retail traders place their stops, and they target them with precision. Here's a classic scenario. Let's say you entered a trade at the support. Then you put your stop loss just below it, the market dips, stops you out, and then shoots upward without you. That isn't random, it's a liquidity hunt. Now, to trade like the institutions, you must learn where liquidity rests. ICT gives us 2 main types. The first is buy-side liquidity, which refers to buy stop orders sitting above the price previous highs. The weekly or daily highs or equal highs. Why do people place their stops above those highs, you might be asking? This is because the traders that entered shorts want to protect positions and breakout buyers place orders above resistance. The institutions know this, so they push price just beyond those highs, trigger stops, use that surge of buying to fill their own sell positions, and then reverse the market upward. That's what's known as a buy-side liquidity grab. Now that you understand the mechanics, let's break down 2 common liquidity traps you've probably witnessed. First, the sell-side trap. Say the market is trending downward, and you see a strong support level. You then decides to enter a long trade, expecting a bounce with your stop loss below the support level. Meanwhile, breakout sellers are stacking sell orders beneath the same level. Price dips through the support, triggers both groups of orders, and then reverses upward, leaving both the sides trapped. The real trend only begins after that liquidity is cleared. Now, let's check out the buy-side liquidity trap. Imagine the market stuck here. You can call it a ranging market. Then you identified the resistance level and then start thinking this is the perfect place to go short, placing your stop loss just above it. At the same time, breakout buyers are stacking buy limits above that same level, anticipating a bullish breakout. What happens? The price spikes above resistance, wipes out the stop losses, triggers the breakout buyers, and then quickly snaps back into the range, taking both sides out of the market. That whole move was a liquidity sweep, a textbook buy-side stop hunt and a ranging market. There's more to liquidity that I cannot cover in this video, so if you want me to create a detailed video on liquidity trading model, comment down below and subscribe to the channel to get notified when the video is live on the channel.
Now with liquidity understood, let's move on to one of the most fascinating patterns institutions use, the power of three. This model breaks price into three phases: consolidation, manipulation, and acceleration. In the first phase, which is the consolidation, the institutions quietly build positions while price ranges sideways. To retail traders, it looks like indecision, but it's actually preparation for a big move. Then comes the manipulation phase. Here, the price fakes a breakout above or below the range to trap traders, triggering stops and luring breakout entries. This liquidity sweep is engineered to collect orders, and once the liquidity is secured, the institutions drive price hard in the opposite direction. That's the acceleration or distribution phase, where momentum takes over and the traders who spotted get the chance to ride the real move. That's the bullish version. For the bearish version, the setup begins at the end of an uptrend. Phase 1 is accumulation. Price consolidates while smart money offloads long positions to eager retail buyers. Next, the manipulation. This is where the price spikes above resistance, triggering breakout entries and stops from short sellers. Retail thinks it's a continuation, but it's a trap. The price quickly collapses back into the range, revealing the sweep. Finally, the markdown phase begins. Institutions have exited, liquidity has been cleared, and price drops with momentum. This is your chance to catch the move from the very top. Now, how do you trade with the power of three? Say in uptrends, you watch for accumulation. The price ranges after a strong rally as smart money takes profits. Then comes manipulation. This is where the price spikes above resistance. If the breakout candle closes back inside the range, that's your signal that this is a liquidity sweep, not a breakout. You may decide to enter on the close of the follow-up candles and place your stop loss above the high and target the next support level. This way, you ride the distribution created by smart money. Now, in downtrends, you look for accumulation after a sharp fall. The price ranges, then dips below support, triggering sell stops. If the next candle closes back inside the range, then your entry will be at the close of the next bullish candle that will form. And then you place your stop loss below the low and target the next resistance. This lets you ride the markup fueled by institutional buying.
So, this power of three combines the accumulation, the liquidity sweep in the form of manipulation, and finally, the distribution. This is one of my favorite model and smart money trading strategy.
Finally, an order block is another cornerstone of ICT. Simply put, an order block is a zone where institutions place massive buy or sell orders. These aren't retail traders. These are banks and hedge funds with millions at play. When these people enters the market, the price reacts sharply, rejecting from that level. And this often represents a footprint of smart money. And these zones is the order block. Bullish order blocks form from heavy buying and bearish ones from heavy selling. Once created, these zones become areas of interest because the price often revisits them to test whether the institutions will test that level again. For us, those retests can offer high probability trade opportunities. At first glance, order blocks may look like support and resistance, but they're different. Here's how. First, support and resistance form after repeated rejections. If the price bounces multiple times, traders draw lines. But order blocks come from aggressive institutional moves, not just rejections. Second, support and resistance are drawn as thin lines or narrow zones, while order blocks are broader, representing clusters of institutional activity. Third, support and resistance can be respected repeatedly, but order blocks are more like one-time opportunities. Once price revisits and reacts, they often lose power because the original orders have been filled. So, how do you find valid order blocks? We have 3 rules to identify a valid order block. The rule number 1, there must be an imbalance. So a true order block is born from inefficiency, where price moved too fast and left a gap. That imbalance is key. To mark it, take the last opposite candle before the whole price movement that created the imbalance and draw a rectangle from wick high to wick low. That's your order block. Rule number 2, the order block must be unmitigated. So if the price is already tapped into the order block, it's no longer valid. The institutions have filled their orders and moved on. Rule number 3, the order block must be confirmed with a break of structure or change of character. Without this, it's just guesswork. For a downtrend, you want the price to break below a previous low. For an uptrend, you want the price to break above a previous high. A shift in structure confirms institutional intent. Here's an example. You can see that the market makes a sharp move to the downside, leaving an imbalance. It looks like an order block, but we need confirmation. When the price breaks below this previous support level, now the order block is validated. So when the price retests the order block, you can see that the price rejects and continues lower. Here's another example. You can see that price moves upward, leaving imbalance. So we identified and drew the order block. A second imbalance forms higher, aligning with previous resistance. That adds confluence. When the price retests the order block, you can see that the price rejects and continues higher, confirming the order block as valid, and this is supported by the market structure. Now, this is a whole deep dive into the ICT concepts. If this video helped you better understand the fair value gaps, liquidity, the power of 3, and order blocks, don't forget to like, subscribe, and turn on notifications so you never miss the next strategy breakdown. Thanks for watching, and I'll see you in the next one.
Thanks for being there. Yeah.
Join our Telegram channel for weekly expert-curated trade signals. And for premium subscribers, our VIP Signal channel offers higher accuracy and more frequent trade opportunities. Don't settle for average trades. Join a community that consistently wins. Click on the link in the description to start capitalizing on the market like a pro.